In the previous videos, you've learned about partnership formation, partnership operation, and partnership dissolution. Now, let's go to the next topic, partnership liquidation. After 10 years of 3J's partnership operation, the 3J's partnership statement of financial position balances are presented below. Cash, 1,253,050, non-cash asset, 3,750,125, liabilities, 253,175, loan to Jake, 250,000, Joe capital, 2,660,000, Jane capital, 1,350,000, Jake capital, 490,000. Non-cash assets were sold for 1,500,000. Jake is insolvent and the rest of the partners are solvent. There was no agreement on the profit or loss ratio after the retirement of John, and the admission of Jake in the previous video, partnership dissolution. In partnership operation, dissolution, and liquidation, if there was no profit or loss agreement, the partners will use the original capital contributions as the basis for allocating income or loss. And in this case, we will use Joe, Jane, and Jake's original capital contribution as profit or loss ratio, which is 222,500 for Joe, 180,000 for Jane, and 97,500 for Jake. 3J's partnership. Statement of partnership liquidation. Balances before liquidation: cash, 1,253,050, non-cash asset, 3,750,125, liabilities, 253,175, loan to Jake, 250,000, Joe capital, 2,660,000, Jane capital, 1,350,000, Jake capital, 490,000. It says in the problem that non-cash assets are sold for 1,150,000. We will record the sale of non-cash assets by adding 1,150,000 to the cash, or debit cash account 1,150,000, then, deducting the full amount of non-cash assets, or credit non-cash assets amounting to 3,750,125, and we recognize a loss on sale amounting to 2,600,125, which will be distributed to the partners based on their original capital contributions because there is no P&L agreement, but in case there is, then, use the P&L agreement as the ratio in distributing loss on sale of non-cash assets. Balance after sale of non-cash assets: cash, 2,403,050, non-cash asset, 0, liabilities, 253,175, loan to Jake, 250,000, Joe capital, 1,502,944.38, Jane capital, 413,955, Jake capital, negative 17,024.38. We will record the payment of liabilities by deducting 253,175 to the cash, or credit cash account 253,175, then, deducting the full amount of liabilities, or debit liabilities amounting to 253,175. Balance after payment of liabilities. Right to offset. Insolvent partner or partners have the right to offset the loans of the partnership. And in this problem, insolvent partner Jake has the right to offset his negative capital balance to the loans of the partnership to him. After allocating the sale of non-cash assets, and paying all the partnership liabilities, the remaining cash will be distributed to the partners. The basis of cash distribution will be the ending capital balances of the partners after all the considerations made. Balances paid to partners: Joe capital, 1,502,944.38, Jane capital, 413,955, and Jake capital, 232,975.62. Which is equal to the cash balance of 2,149,875. Computation of loss on sale of non-cash assets. 3,750,125 non-cash asset, minus 1,150,000 cash proceeds, equals 2,600,125 loss on sale of non-cash asset. Joe, 2,600,125 multiplied by 222,500 over 500,000 original capital contribution ratio equals 1,157,055.62. Jane, 2,600,125 multiplied by 180,000 over 500,000 original capital contribution ratio equals 936,045. Jake, 2,600,125 multiplied by 97,500 over 500,000 original capital contribution ratio equals 507,024.38. Note: the problem says that Jake is insolvent. In this problem, Jake uses the right to offset the loan. In this problem, the remaining partner doesn't need to absorb the loss of the insolvent partner because Jake's loan is sufficient to cover the negative capital balance, but in case the partnership loan to the insolvent partner isn't enough to cover the insolvent partner's negative balance, the remaining solvent partner will absorb the negative balance based on P&L ratio of the remaining solvent partners.